It's funny, when I was at the University of Chicago in business school, that was back when my marketing class, I think, was like calculus back in the old days. Chicago was a pretty quantitative place, still is to a degree. And, one of the things we learned there, or thought we learned there, was that, there were theories and models that describe the marketplace. And that if you applied yourself to learning underlying theory, you could understand the markets to some degree. And with that understanding, you could have confidence in the decisions you made. Now, a lot of times those decisions were, they were based on an understanding or a belief that the markets were efficient, that they were knowable to a degree, and they were based on, I would say, a level of transparency and a level of information that you would use to make those decisions. I think what's happened in our world over the last year or so, and increasingly so in the last couple of months, is that what we thought we knew, we really didn't know. And the premises upon which we were making a lot of decisions proved to be invalid premises. And it's thrown our capital markets and it's thrown many of the in sort of the financial underpinning of much of our economy into a place of real concern and into a place of instability. So as business school students here, it is really a remarkable time for you to be looking at all of what's happening in the world, looking at the decisions that government is making to address the issues that we're seeing in the world. And taking a step back to say, what does it all mean, and how does this all work, and why, and apply yourself to sort of the academics behind this, because we're at a time in history like none other, period. And I think we've heard a lot of comparisons to what our country went through in the 1920s and 30s, but the difference is, I think we have people at the heart of our government who have spent their lives studying and understanding these kinds of issues, and now are applying policy and kind of the ballast of the federal government to resolve issues in a way that we've never seen before. So it's from an academic standpoint, given where you all are sitting, it's a fascinating time, and it's a great time to be throwing yourself into it to say what's really going on here and why are we doing this. Now, let me tell you a little bit about what HUD does. HUD stands for the Department of Housing and Urban Development. And if you think about the entire spectrum of homeownership, or the entire spectrum of housing, we touch every point of it. We help homeless people get a roof over their head. We help people who have very low income, people who have moderate income find affordable housing. We help homeowners get their first home because we have something called FHA, which insures private mortgages. Today, FHA has taken on a dramatic role, one that's dramatically larger than what they've had historically, because two things are happening. Number one, more than we have in many years, more than we've seen in many years, we are the provider of choice for new mortgages to people seeking to buy a home. And as all of you know, being here in California, we have a significant supply-demand imbalance in our housing market. We need home buyers to come into it and to absorb some of that supply. And we are an important vehicle for enabling those home buyers to come into the market and be able to finance a home. Secondly, however, there are a lot of people out there who are in a mortgage today that they either can't afford because it's been reset, or they won't be able to afford when it does reset down the road. And we've seen hundreds of thousands of people coming our way to refinance out of one of these subprime instruments into a safe, affordable 30-year mortgage, because that's what we insure, 30-year fixed-rate mortgages. So our mission has expanded dramatically. Our volumes are 3 or 4 times what they were just a year ago. We've gone from 2% of the market to over 20% of the market, and it has really changed the role and the dynamic of the agency within all of this. Now, one of the things about mortgage finance in our country that has happened as a result of this whole, this whole crisis is that the government, the federal government, effectively supports over 90% of the new mortgage financings in our country. Probably something most people don't know. But Fannie Mae and Freddie Mac are two very large organizations that buy loans from lenders and package them and then sell them to the public market, and they guarantee those mortgage-backed securities. To some degree, they buy mortgage instruments and hold them on their balance sheet, and that takes the asset off the books of a financial institution and effectively puts the liability for that on Fannie and Freddie. We at FHA, and to an extent through the Veterans Administration, we insure mortgages that private lenders make, and then often those private lenders will sell those to the public market, securitizing them through one of our vehicles called Ginnie Mae. So Fannie Mae, Freddie Mac, and Ginnie Mae are effectively the market for new mortgages in our country. And as I said before, over 90% of the new mortgages are coming through them. So the federal government effectively has stepped in, is providing the liquidity, and is enabling that marketplace. And certainly it has been an essential part of keeping the credit flowing in our country for new homes at a time when there is a tremendous need for home buyers to be able to make responsible decisions and get financing to make those decisions. So it's beyond that, just personally, it's an incredibly dynamic time to be in Washington. I think those of us in leadership see the effects of our decision being relevant every day in what's happening in our world. And as somebody who, just as a sideline, and then we can open it up for the discussion, as somebody who started in business, started my career in an MBA program, went to work on Wall Street for a number of years. By the way, I have to take that Lehman Brothers reference out of my bio. Started my career on Wall Street and then went into corporate leadership. I have to tell you, as you all think of a pathway forward for yourselves, the skills you learn as a business person, the decision-making skills as well as the leadership skills that you build over time are so applicable to government service more broadly, and also I would say very much needed in the government, because one of the points I consistently make when I'm talking to legislators or other people is you can have the greatest programs in the world, you can have the greatest policies in the world, but if the organizations aren't operating effectively in running those programs, you're really not doing people any good. If you could have, when I came into the SBA, one of the things SBA does is we provide disaster loans to people who've lost their homes in a disaster. They were 3% loans. It's very cheap money. If it takes you 9 months to get the loan, it doesn't do you any good. And so really at the heart of compassion, I've consistently told people, at the heart of compassion in the federal government is the ability to deliver services effectively in a way that matters to the people receiving them. And I think as a result, people who've got classical business training are prime candidates, I think, for government service.
So I have a few questions. So one is, it's been a long policy in the United States to increase the number of homeowners. And in terms of, I've taught a real estate class here for a long time, and in terms of basic real estate issues, it's not obvious that that's a goal. I mean, we don't think it's a good thing if U.S. corporations owned their office buildings rather than rented them. So along with this goal has come some success, in essence, as more Americans have become homeowners. I believe the percentage is at an all-time high. But on the downside, we now have loans that probably wouldn't have been made 15 years ago that have been securitized. Mm-hmm. So do you think it remains a worthy goal to increase the number of homeowners? And how would we achieve that?
Okay. I think it's a very worthy goal to promote responsible homeownership. And for the lion's share of the last several decades. Homeownership, I think, provides people stability. It provides them a vested stake in their communities. I think when you own a home, you're anchored much more in that home in a lot of ways. And it's also, historically, notwithstanding what's happened recently, an important avenue for ongoing wealth creation. And many people, when they retire, look to their home as an important source of value as they go into their retirement years. And so I think responsible home ownership is important. I think what we saw in the last few years is tremendously irresponsible behavior throughout the system. And I think it happened everywhere. I think you had people coming to the mortgage table and entering mortgages that ultimately they couldn't afford. And they were making bad decisions and risky decisions. And it was done so, I think, with a lack of judgment. Now, many of those people didn't have the tools to understand what they were getting in, and many of them were victims of predatory lending. I think we all agree with that. So you had some challenges on the part of the person entering the mortgages. You had, to some degree, bad behavior on the part of lenders. I'm not saying it was everywhere by any means. We've got some terrific ethical people out there, but there was a culture there as well. And then, having started my career in Wall Street, I'm particularly baffled by the degree to which these loans, which were very different than we'd seen historically, were packaged and sold to financial investors around the world when they were instruments that we'd never seen before, to people with credit profiles that had never borrowed before. And it was just such a massive and proliferated phenomenon. I think it's remarkable to many of us that it actually went as long as it did with buyers at the other end, because it wasn't as if there were sort of a handful of people engaging in these activities. So I think 04, increasingly in 05 and 2006, there was a lot of behavior that we'd never seen before that I don't think really should taint what happened for decades before that in terms of policy goals. It should, however, I think, instruct our policies forward and our decisions forward so that it doesn't happen again.
So a question about the general nature of the mortgage-backed security market. I and many people think there are lots of really, really efficient and good things about the whole process of securitizing home loans. In essence, it's taken what used to be a very private, localized market,
Sure.
where if you want to borrow in Nebraska, you have to go to an S&L in Nebraska, to basically having homeowners tap the world credit markets. So there's lots of great things about that. And to some extent, until recently, default rates on these securities were very, very small, way less than 1%. But one thing that I've seen is now as the defaults become more common, there's something really difficult about this process in that it's very unwieldy to have efficient renegotiation between lender and borrower. In the old days, you could talk to your local bank and you probably come up to a mutually beneficial agreement how to salvage these loans. How do you do it today when it's become so separated by geography?
Yeah, it's made it very difficult, and it's even more complicated than that, because effectively what happens is you have a pool of mortgages. It's put into a vehicle, and you're not necessarily just selling mortgage-backed securities, one set of mortgage-backed securities. Traditionally, you have sort of a pass-through where just the payments from the mortgages go to those bondholders. But it's also been sliced and diced, so you have people getting, buying the interest, buying the coupons, people buying different tranches of risk. And so all of a sudden, each individual mortgage may be feeding several different issuances of bonds. And then on top of that, many of these homeowners actually got second mortgages. So you have two different lending institutions in the middle of it. And it is severely complicated, the process of somebody going forward and saying, I just want to fix the problem. What can I do here? And so there's two things that have really been critical. Number one is you have to be able to work with a servicer of those mortgages to effectively renegotiate with the homeowner. And there have been a lot of impediments there. It depends a lot on the specific agreements they have in place as servicers for these mortgages, because different servicers have a different degree of latitude. And it also has to do with the fee arrangements that these servicers have, because they don't own the mortgages anymore, and it takes a lot of work and it's costly. Now, the industry has come together for something called the Hope Now Alliance, where 27 servicers who represent about 90% of subprime mortgages in the country have come together and agreed upon some common principles on how to modify loans. And since they did that in summer of '07, we've seen over 2 million loans in some way worked out, and almost 1 million of those have been actually modified. Interest rate change, maturity change, maybe principal written down. So we've made good progress, but it's terribly complicated. And I think for us to reach individual homeowners and help them along the path of finding a mortgage they can afford, that's where a lot of the issues are going. That is where a lot of the issues are going to reside, and where we're going to have to focus our attentions.
So, as most people realize, that what's going on as far as the financial crisis is fundamentally at its base a real estate issue, a home price type of issue, and the concern obviously is that what we have right now could be feeding on itself. You have home price declines, and then you have homeowners defaulting, foreclosures, fire sales of assets causing further price declines, and you have this snowball rolling downhill type of phenomenon. Is there anything you think policymakers can do to sort of stabilize the underlying asset market?
Yeah. Now, the thing to understand is the housing market is massive. So, and there is a fundamental supply-demand imbalance. So there is, there are targeted policies and programs that you can use to address some of the issues. But also, I think more broadly, it becomes a broader economic issue. Okay, so you have the housing market in and of itself, but you also have the broader economy. So there are a handful of things I'd focus on. Number one, to the extent that the economy gets back on its feet and stays strong, it will be beneficial to the housing market. The two are very closely linked. And if you've looked historically at economic downturns and specifically recessions, during a period of economic downturn, the housing market turns down, and it's usually a front runner to a recovery. So they're inextricably linked, and we need to focus on the health of the broader economy. That's number one. Number two, as I mentioned before, we need to ensure that there's liquidity for home buyers, so that when people actually can come into the market, want to come into the market, they can begin to buy up some of this inventory. Beyond that, I do believe that we need to have increasingly aggressive foreclosure prevention measures. Now, I mentioned we've already refinanced in just over the last year 400,000 people. It's a very significant number. Industry has worked out over 2 million difficult loans in the last probably 15 months or so. But the issue isn't going to go away. And we have very significant numbers of loans resetting the rate going into 2010 and even 2011. And if you look at the number of foreclosures in the country, it's gone from 600,000 or 700,000 in 06 to almost 1.5 million in 07 to well over 2 million this year. And if you look at 2 million plus foreclosures, there may only be 6 million new homes sold in the entire country, and it's an increasing issue. So we're working very hard with industry on different and various other initiatives to try to reach those homeowners, to get them into programs that would help them get into a loan that they can afford, that would enable them to keep the home. But I think for those of you who stay close to kind of the policy debate, I think increasingly one of the questions is going to be, do you allocate money to help people one person at a time? Because ultimately, every one of these is an individual situation, or do you take sweeping measures to alter, millions of loans in one fell swoop and suffer all the costs associated with that, with the understanding that somehow that's going to get at the broader issue. And if I had to kind of fast forward a few months, I think that may be where the policy debate goes.
Okay, so I'm going to turn over the questions to you. What I ask is, if you have a question, you get called on, stand up. I think there's 2 microphones in the room, and someone will come to you.
very much for joining us. Appreciate your coming out here. Appreciate your comments with regards to the ownership society and the value of individuals owning their own home. With regards to irresponsible lending, both Senator McCain and Senator Obama have been out there talking about the need for greater regulation. In fact, it seems that the federal government's role in lending is more directly involved with irresponsible lending. We look at HUD, which placed the requirement on Fannie and Freddie that 22% of all their mortgages go to people below 60% of the median income line.
Yeah.
We look at Fannie and Freddie being able to borrow at a AAA rating despite a AA- rating under the assumption of a federal backstop. To what extent do you think it's in fact the case of the federal government that perhaps politicians' desire to incentivize an ownership society might in fact be responsible for a lot of the problems that we face today?
Yeah. Well, that's a question that's right in the middle of a lot of what we're discussing. A couple of things. Fannie and Freddie historically were sort of an unnatural blend of activities. Okay, they had an affordable housing mission, which is one of the reasons they were set up to begin with. I would in no way. I fundamentally don't believe that the fair housing mission, that the affordable housing mission they had, was even primarily the cause of the issues they've had. I think it's much broader and more complicated, and we could wax eloquent on that for a while. The bigger issue, I'd say, though, is when you look at what happened in 04, 05, and 06, most of these loans that were being made were not, they weren't the kind of loans that were originated as part of a Fannie and Freddie program. None of them were originated as part of a HUD program because those weren't the kind of loans we did. Most of the subprime, the loans that are known as Alt-A, option arms, were loans that were done in the private sector and then sold without government support. And so one of the reasons why, and it was a massive market. I mean, there's $1 trillion plus of these kinds of mortgages out there. Packaged in mortgage-backed securities and sold to financial institutions and investors around the world. So when those loans started underperforming and we started seeing the default surge, most of those were outside of the entire Fannie Freddie system. These were all part of the private system. And in fact, that's part of the reason it's tough for us to get to them is because we don't touch them. They're all in these pools around the world. So and that's really the big part of the worldwide shock we're going through today. And so I wouldn't put that on Fannie and Freddie. Now, when you look at what Fannie and Freddie do, I think it's really important for us to say, is it a good idea to have to try to promote home ownership in our country to people who might not be able to afford it otherwise? I think it has tremendous merit. But is it right to do so through Fannie Mae and Freddie Mac? I mean, there are a lot of ways we incentivize behavior in our country to help people who may need a little bit more help without necessarily doing it through that kind of a vehicle. And so those are all the policy questions I think we need to get into. And I don't know the path forward for them, but I will tell you, having a publicly owned company that's answerable to shareholders with a implicit guarantee by the federal government on its debt, and having sort of this mission mix on the affordable and housing and the profitability side. It's sort of an unnatural agglomeration of things, and I think going forward we're going to have to kind of look at each one of those things individually and say, what's the best path forward if these are our goals. So, but I do not want to leave you with the notion that either what happened in Fannie and Freddie is what's happening more broadly in the world, or that their affordable housing goals were the primary cause of what they went through, because I don't believe that. Yes, ma'am.
Thank you. Can you talk a little bit about some of the specific programs you're working on as far as helping homeowners facing foreclosure? whether you said either kind of on an individual basis or a systematic basis, and also how you see that potentially conflicting with your other goal of encouraging lenders to continue to make loans and provide liquidity in the market?
Okay. There are a handful of things. First of all, we are focused on helping people refinance out of bad mortgages into good mortgages, and that's done through our FHA insurance programs. Now, in summer of 2007, we began broadening eligibility for our programs to include people who'd begun to go delinquent. And before, if you'd entered delinquency, you wouldn't have been eligible for our programs. So people who'd begun to miss payments because they were in a subprime loan that reset, we began to say, okay, if you have a history of payment, but your rate went up and you can't pay anymore, let's open our program to you. And then this past summer, we broadened that a bit further. Then in a housing bill that was passed in July, we were able to broaden. There's a program in that bill called Hope for Homeowners, which allowed FHA to begin offering mortgage insurance to people who'd actually gone into foreclosure. I mean, so people who were really far down the road. That's a program that says, okay, we'll come in and we'll guarantee a refinancing. But the lender has got to do two things. Got to write down the loan so that it's no more than 90% of the fair market value of the home. So there's a 10% layer of equity in it. And they have to make sure that based on that write down and the new interest rate and the new maturity, that it's affordable. And we have certain metrics in there to determine affordability. So there's a cushion against the home going underwater again, and there is the loan should be affordable so that, because we don't want people going back into foreclosure. And for the lender, if a lender forecloses on a home, typically they lose 25 to 40% of it. Cost a lot of money, cost legal money, administrative money. They lose interest payments, and then when they sell it in a fire sale at the other end, they lose a lot of money. So there's definitely sort of an intersection here between where a lender will say, I'll modify and even write down that loan, and the homeowner says, I can afford that new loan. And if we come in and say, okay, if you guys can make that agreement in terms that we think will work, we'll then insure it. And so that's a program that we've got that we just launched, and lenders are just signing up for it. Now, the other thing that we are very involved in is financial literacy, both at the front end before people get mortgages, but also once they get a mortgage to do foreclosure counseling. And, in the President's 2009 budget, he's asking for $65 million for housing counseling. That's 2.5 times where it was when he came into office. Additionally, when you look at a couple of bills that have been passed in the last year, that number has been dramatically expanded. So when you look at everything, there's $400 million in money for housing counseling. That is really important to get after this stuff for a number of reasons. A lot of people who can't pay their mortgages also have just some challenges managing their finances generally. And sometimes people come in, they can make some lifestyle changes, they can rework a couple of things, and lo and behold, they can put themselves on a payment plan that actually works. Number two, or B, I think I was doing letters. B, people call up a lender, they don't know what to ask for. They don't understand their mortgages. All these terms are confusing to them. If you can go to a housing counselor and sit down with them, a lot of time those housing counselors can sit down and say, look, maybe modify your behavior here, but let's talk about something you can afford. And let's talk about how we should talk to your lender to get you into a mortgage that you can afford. So they can actually work with people, represent them with lenders, and chart a path forward that works for both sides. And so we are huge believers in counseling for loans that are in our portfolio once they've begun to go delinquent. We actually have aggressive outreach programs. We modified, we saved about 100,000 people last year through our modification programs. Almost everybody we work with ends up keeping their home. I mean, the success rate is, I keep asking people, are you sure this is right? Show me the numbers. It's remarkable. I was at a counseling agency yesterday in Seattle. I talked to some of the counselors there. One of the counselors I talked to said they've got a 90% plus success rate for people that come in for foreclosure counseling in keeping their home. So those are the two primary things: expanding our programs to refinance people out of bad loans into good loans, and then supporting counselors who can sit one-on-one with people to get them into a better situation.
Secretary, I was wondering if you could provide some more color as to how successful you are in terms of just the general number of people who come to you for help and what percentage actually can resolve their problem and how much time that takes. If there's any data you have as to how many cases you see on a monthly or quarterly basis.
I wish I had better data.
Also, if you think this rate is accelerating or if it's kind of reached a plateau, if we have seen the worst yet or not. Thank you.
Okay, great. I don't have great. Most of what I have, and this is unfortunate, but most of what I have is anecdotal or data from individual agencies that I talk to. I don't have kind of an aggregation of information on that, and I wish I did, but I don't. What we hear are a few things. Number one, we hear, as I mentioned before, that good housing counselors can save a lot of people, and that a high percentage of the people that they work with can actually get help, and that they're successful. That's number one. Number two, it varies by institution when you actually talk to lenders. Some lenders have taken pretty bold moves. Some lenders have frozen resets for everyone for a period of time while they work through it. Other people are getting much more aggressive in pushing through loan modifications where they're actually altering the loan itself dramatically to make it affordable. People have expanded their staff by multiples to handle the phone calls coming in so they can handle that workload because it takes a lot of time and effort to restructure a loan. And those lenders are having a lot of success. But on the other side, we're seeing, we still hear stories all the time about people who, call up the lenders, they can't get help, or they don't fit into a box. The lenders might have kind of very tight criteria, and people don't fit into that box. We even have people who say, I'm about to go delinquent. I am behind on everything else. I'm going to stop paying my loan. And the lender might say, look, unless you're 90 days delinquent, we can't help you because our programs are only for people who reach a certain level of delinquency. So we've got the whole spectrum, and unfortunately, I think in some ways it very much varies by whom you're dealing with. What was your second question?
If this is getting worse.
If it's getting worse. Unfortunately, the trends on foreclosures have continued to get worse, and we haven't seen any plateau there. I'm concerned, and they're at an extremely high level. And so, there are a couple of things that would potentially move it in the other direction. Number one, we are seeing a much higher degree of adoption of all these programs. The word is getting out. Early on, people just didn't know what was out there. I had a roundtable last month in California. There were all these local leaders. There were 6 mayors, and they didn't know about half of the things that they could be accessing. I mean, even in Southern California, which is really one of the epicenters. So I think the bigger problem is going to continue to be in front of us because we do have, over 12 million people who are underwater on their mortgage. Mortgage is more than the home. We have a lot of resets coming at us, and we're in a tough spot in the economy. So for us to get ahead of this, I don't think there's going to be a pullback anytime soon. For us to get ahead of it, we're going to really have to continue to be very aggressive in rolling out these programs.
Thanks again, Mr. Secretary. One of the consequences of the financial crisis is the government now has taken a huge ownership stake, admittedly not in a voting capacity, in the financial system. And two questions. First, as a person who has experience on the banking side and the government side, what do we need to be thinking about? And two, in terms of the proposed, asset relief measures, what do we need to do to think about purchasing these assets at prices that meet the competing objectives of recapitalizing the banking sector and being fair to the taxpayer?
Yeah, great question. one thing I can assure you is there are a lot of very sharp, very talented people who are going to be in the middle of that mix in terms of valuing the assets, purchasing the assets, and managing the assets. And the Department of Treasury is in the process of bringing in a number of experts from the outside to actually manage a lot of that. So that's good news. The other thing that's important to note is, I think these measures, a lot of these measures are being taken. We've under the. Let me take a different angle here. $700 billion plan. That's what you're referring to. The Troubled Asset Recovery Plan, the TARP, which until 2 months ago was what we all put on our roofs if we had a shingle problem. The TARP, $700 billion. Treasury has very quickly allocated $250 billion for these preferred stock purchases, and they're buying preferred, and then I think getting warrants for 15% of the value of the preferred. The idea there is to, and half of that money, half of that 250 is going to 9 institutions that we think are central to our financial system. Some of them are big, some of them are very important for transaction flows. So the money's being put in those institutions because we want to say, look, everybody may not need it, but we don't want any questions out there. We want to make sure that everybody has got a strong layer of capital during a time when institutions are coming under a question that nobody would have ever thought would come into question. So the reason I lay that out there is because it's done to stabilize the system, it's done to stabilize those institutions, and it's done in a way with institutions that ultimately we really should not be concerned about, where ultimately we shouldn't be concerned about their long-term viability. There are incentives in that to bring along private investment. There are incentives in there for them to get out of those equity positions not too far down the road. And everybody who's working on these to structure these arrangements is doing it with a view that we want to stabilize the system, but we also want to invest in an asset where we can recover our investment and potentially actually have a gain, which I think in some cases we might see. So, and there are a lot of smart people in the middle of doing that. So ultimately, I think it's everyone's hope that that particular set of actions will not have a cost to the taxpayer. And ultimately, by stabilizing the system, the broader cost to people who pay taxes, all Americans, the broader impact on our economy, on our ability to create wealth in our country, to create jobs, to have businesses function effectively, will be very favorable. And so the other thing, I'd say is these actions are designed to be temporary and designed to be focused on getting a free market capital system sort of dislodged, healthy again, and then be able to pull out of it. So I don't know if that answered your question. I guess not, since you're raising your hand again.
A follow-up. I guess my question is, are there agency problems that are created now the government isn't? Everybody agrees we need more regulation, but now the government is a huge owner of the financial system. What do we need to think about in terms of regulation? Are there any?
Well, the regulatory issue is a complicated one that is going to be in front of us, I think, for the immediate future. And I think once we get past this whole wave of implementing all these programs, and really for the next administration, I think the regulatory overhaul has got to be front and center. Now, Secretary Paulson has laid out sort of some comprehensive views on what he thinks need to happen in the regulatory front. But I think it's clear to a lot of us that our markets and our institutions had far outpaced our regulatory infrastructure. And I don't think we've gotten to this debate, do we need more regulation or less regulation? I don't think that's really the debate. I think the debate is we need relevant regulation that's adapted to, that's appropriate for the marketplace that we're in today and the way that the institutions in that marketplace function. So I think it's more different regulation, and I think that's really what some of what the Treasury Secretary laid out. But the regulatory pathway forward is absolutely got to be front and center from my perspective. I haven't actually turned to this side before. You got all sorts of.
Again, thank you for joining us today. I wanted to hear about your kind of experience to date and expectations for redefaults of people who have been worked out post-workout, in the sense that now that FHA is insuring these post-workout loans, you have to make expectations about how many of these people will redefault and losses given redefault, as well as kind of your views and the view in Washington concerning the moral hazard associated with blanket reforms that could actually economically incentivize people who could make their payments to default to experience these workouts and to experience kind of write-downs on their mortgage payments.
Yeah. On the redefault issue, I think there is a lot. There's a lot in how you modify a loan. I think when we see people come in who can't pay a loan and the lender says, well, let me put you on a repayment plan, let me tweak it a little bit, if you don't get somebody to a point where they can really afford the new loan, you're going to see a high repeat rate. And there are certain slices where we have seen very high repeat rates. Now, there are other areas where we've seen people go through more tailored modifications, more extensive modifications, and I want to put one more plug in here, through foreclosure counseling, where we've actually seen very low repeat rates. And so, I think there are people out there that have, premises on both sides of the spectrum, and I think we need to be cautious about both of them. Some people say, well, look, if they default in the past, they're going to go right back in, and you're just going to lose that money again. And you have other people that falsely assume, well, if you fix the loan, we'll never have the problem again. It's really somewhere in the middle, and it has a lot to do with how you do it and making sure that when that person goes forward, they have something they afford and they get the support they need to be able to manage that. Now, on the moral hazard issue, this is every step of the way something we have to be vigilant about, because our view has been, if you're in a home and you've got a mortgage, even if that home is underwater, you should pay your mortgage. You entered a contract; it's an obligation, and that's what we do. It's an obligation you have to a lender. And when you look at the policy ideas out there, to the extent that they become too broad or too inclusive, you do potentially motivate people to come into a situation and when they actually can afford to pay their loans, and it expands the cost of the program, it expands the impact on the economy, it expands obviously the impact on taxpayers more broadly, and that's why I think we have to be very cautious about some of these some plans that would have a much and I want to acknowledge before I say this that if you have a broad plan that addresses a very large number of people in one fell swoop, it's a lot easier. You can get it done quickly, and you can touch people a lot more quickly than doing it sort of one person at a time. But you have to be very careful about how you do it, and because if you take a very broad approach, it can be extremely expensive. You can make adjustments for people that still can't pay their loans afterwards. And you may be writing down a bunch of loans that you don't need to, and so it's an area, like I said, we've got to be very vigilant, and that also is going to be right in the center of the policy debate going forward.
That's all right. You said it yourself that you took a broad measure that it would be quick. I think that's the issue at hand, right? All along the way through this financial crisis, there's been a lot of concerns raised about moral hazard, and and you can correct me if I'm wrong. In some ways, I think that's played into our government's piecemeal approach to what's going on in the banks, what's going on in the housing market, where really I think the crisis was moving much faster than we were responding to it. Can you talk about, do you think moral hazard's been overplayed, and do you think what we could have done to stop this, and do you think going forward, is it going to be that sweeping reform? And is that the only thing that can happen? And then afterwards, is moral hazard should be something that we worry about as we redesign our regulatory system?
Yeah, well, I think if we address part of the challenge in answering that question is we're actually talking about a lot of different things. We're talking about homeowners in the mortgage market. We're talking about the broader measures to stabilize the economy. There's all sorts of things kind of in what we've seen over the last 6 weeks. So if I pull back fully, okay, and just sort of look at the whole picture here, what we're continually having to do here is balance the cost of a lot of these measures balance the cost of action with the cost of inaction. Okay? And, I made a speech this morning to the Mortgage Bankers Association, and I was followed up after me. Karl Rove and Senator Mitchell were going to be on talking about sort of the political landscape. One of the things I said was, we're in a very strange situation because we have, we're looking at, such groundbreaking stuff right now that we have liberals saying, but what about the cost of the taxpayer? And we've got conservatives saying we need decisive, aggressive, and complete government action. I mean, it's sort of like all bets are off in a lot of this stuff. But when you get to this issue of moral hazard, I think you really have to take a step back and say, what's the cost of action? What's the cost of inaction? Who does it affect? And weigh all that in making these policy decisions. Now, when you look at the approach the federal government has taken so far, I mean, I mentioned before, federal government right now is 90% of new mortgages in our country, if not more. Okay, so that's pretty comprehensive. If you look at what the Fed has done, what the Treasury is doing, and what the FDIC has done, if you look at a bank's balance sheet, the equity layer, the debt layer, the deposits, almost every line in that balance sheet right now somehow is being aided by a program or an institution in the federal government. So, we're past piecemeal on the approach to the marketplace and the approach to financial institutions. It's pretty complete. When you deal now, but when you drill down to the individual homeowners and individual mortgage holders, I think, in response over here, I think that's where we're still kind of grappling with some of these more broad stroke measures where you go in one fell swoop and take care of a very significant amount of people. And I think, like I said, I think that's going to continue to be right front and center in the policy discussion.
Since we have 5 minutes left, I think this will have to be our last question.
Mr. Secretary, thank you very much for coming and speaking with us today. I wonder, especially for those of us who are in the group who have served in the government or intend to go back to the government, I'm going to risk really changing the direction of this conversation, but
Please change it.
Ask if you can speak a little bit about your leadership style now that you are running a portion of our bureaucracy in Washington and what that means for you on a day-to-day basis, but additionally how you made the transition from the private sector to the government and what recommendations you would give to those of us who anticipate doing the same in the long term.
Well, great. I think it is a terrific honor, a terrific experience, and a terrific privilege to serve. And I just can't emphasize that enough. There is something really wonderful about being able to come in to a role like this, or when I was at the Small Business Administration, and know that all of this great experience that you've built either through a great education or through a great education and relevant private sector service, that you can bring that to bear into public service. And I say that I think that hits on two levels. Number one, there is really remarkable work that's done to help people in our country. And number two, if you can affect it positively, it touches the lives of millions of people. And, I can't tell you how many times I've been out in the field, I've talked to people that have been touched by one of our programs, where I've listened to them play back to me a great experience they've had with our program. And I've mentally been able to attach that to an initiative we had to improve that program. And, I'm talking about the SBA helping disaster victims in the Gulf get back into their homes when they couldn't get their loans. I'm talking about, inner city businesses where we launched a program to help fund, provide technical assistance, introductions to venture capitalists for businesses that we wanted to bring into the city to reinvigorate neighborhoods in our country that needed jobs, that needed investment, that needed an inflow. Talking about HUD, where I was in Chicago a couple of weeks ago, and I lived in Chicago for a number of years, and I was looking at a site where there used to be one of the worst concentrations of poverty and crime in the country, and now it's a mixed income community that's developed that is safe and enables opportunity for people who would have never seen it before. And if you can make that stuff work better, if you can bring your experience and your talent to bear to improve it and help it reach people more effectively, it's just a terrific thing. It really is. Now, in terms of my leadership style, there are a couple of things I believe very firmly. Number one, I believe people want to be led, and they want to be led with a mission that excites them. And I think as a leader, you've got to come into a place and bring vision and show a commitment to a mission. The worst thing you can do coming into an organization, I think, especially the government, because people cycle through so quickly, is have people feel like that it's about you. Because it's not about you, it's about serving, and it's about a great mission. Number two, when you take that organization forward, there are a lot of things that could there's a lot of need, let's just say, in Washington for good leaders and for people who've got good organizational skills. And so what I've made a point to do is to really be very collaborative, be very much of a listener, bring employee groups together, bring people on the Hill together, bring industry groups together to really craft that path forward. Then I've taken that in both organizations I've been in. I've said, okay, this is what we've learned. This is what the market needs, and this is why we think that what the market needs is what the organization needs, and this is where we're heading. And I've taken that and put in both organizations, put in place very aggressive, very focused programs that everybody knows about. So, for example, at HUD, we got the Impact 200 going right now, which is our 200-day plan. There are 15 initiatives. There are milestones on every one of those initiatives. There are owners in HUD. It's all transparent on the HUD website. 8,500 employees can figure out which one of those 15 initiatives is green, yellow, or red in terms of where it's trending. They can see what milestones we're making or missing. They can see what assistant secretary is responsible for it, and they know. And then we communicate. We actively communicate out to them on why we chose those initiatives, how we learn from them to get there, the difference it's making to the people we serve, and the difference it's making to the organization. So, leading with vision and mission, making sure that that's done through a collaborative process, people buy in and they own it, managing it doggedly, helping people understand why those are part of the vision, and then communicating aggressively so that people are engaged in it. So that's kind of what we've done in the last couple of places.
Well, let's thank Secretary Preston for visiting us.
Okay, thank you. Thank you very much.